Hey, this is Jim Damshutter at Portfolio Think Tank, and in light of the recent inflation prints on CPI and some of the anecdotal evidence through a lot of commodity prices and even some of the wage hikes we're seeing at some of the United States' largest employers, the risk of inflation is out there, and it's time to do something about it in your portfolio, especially if you've got a conservative, fixed income oriented portfolio. That kind of portfolio is really susceptible to getting eroded by inflation. So here's how to fix it. Okay, I'm going to go to Portfolio Think Tank. All right, and in Portfolio Think Tank, we are going to design and test a new strategy. This could be a pretty easy strategy. We won't use the advanced options. We'll just click next here, and I'm going to put in one stock I found recently that I think is really well positioned, and I'm not going to define any allocations, shares, or values for it. We're just going to let the optimizer choose the best weight, if any, for it. But I've done my homework on that, and I like to include it. All right, so again, this is a conservative portfolio. I'm sort of targeting this towards maybe an investor that might be like in a 50% bonds, 50% fixed income portfolio. In the new world, that's going to change a little bit. But first, let's go ahead and set the objectives of that kind of investor. I'm going to leave total return here. Return's always important, but for conservative investors, we want to put a little bit more emphasis on things like capital preservation, consistency. You could be more bullish or bearish on market exposure. I'm going to go ahead and dial that down a little bit. I'm going to bring up my diversification. And let's just say this is for a IRA accounts or other tax qualified accounts, so I can don't have to worry about taxes. Current income, if you're getting income on your portfolio in retirement, turn that up. If you're not, turn it down. All right, so I'm going to set mine just like this. This is still a conservative portfolio, but maybe someone that doesn't have to live on the portfolio. They're just maybe getting towards the end of their retirement cycle, or just don't have the mental capacity or desire to withstand risk. Okay. Similarly, risk capacity. Let's just go ahead and say set these kind of in the middle there. And here's where we can get into building a portfolof. I suggest for conservative investors to probably use a fundamental kind of prediction system. Fundamental investing is inherently more conservative than things like technical analysis, and probably more conservative than things like an artificial intelligence. And the other thing I'm going to do, I'm going to use a three asset template here. This is basically saying I'm going to split up the world between stocks, bonds, and alternative investments, and we're going to make the optimizer honor these constraints that I put on it. Now, in a world where I was 50-50, I think the new world like that might be, this isn't bad. Let's just do this. We'll keep it nice and simple. 50% stocks still, but we're dialing back our fixed income exposure from 50% to 25%, with the new 25% being reallocated into alternatives. That's going to help us get some more diversification, and by our selection of fixed income assets together with the optimizer and the prediction engine, we really ought to be able to perform a lot better than bonds, given the terribly low rates and yields in the bond market, compared to some of even the dividend yields that we can get in all kinds of different stock and equity based investments. So looking out for inflation, the number one thing I'm going to pick is inflation indexed bonds, and I'm also going to I'm going to stack that with global bonds and corporate bonds. From the stock side, what I want to do is I want to let diversification really take the driver's seat in managing the risk of the portfolio. So this allows me to take maybe some more individual kind of risks in the equity portion, knowing that at the end of the day I'm going to have good diversification, and I'm expecting that my risk metrics are going to come in line to what they would have been, back in the original conservative portfolio. And if that's not the case, then I don't invest it. All right, so I'm going to pick infrastructure stocks. I want to use one of these dividend ones. I'm going to use Dividend Aristocrats. I'm also going to use platform companies, and I'm going to use genomics as sort of my upside kicker into the portfolio. As far as alternatives go, in light of inflation, remember, this is what we're doing. In light of inflation, things like precious metals, gold mining, commodities, and hard assets are really going to be able to outpace inflation, as that inflation erodes our purchasing power. The risk in the portfolio strategy isn't the risk of losing money, it's the risk of our money not being worth enough to maintain its worth in the future. So I think a lot of investors that might be conservative don't have that particular flavor of risk baked into their portfolio strategy. So if that applies to you, you really ought to do something about it. We had a 4.2% CPI inflation, and CPIs tend to be understated by most understandings of inflation. In a quick scan of commodity prices on a year-to-date basis would collaborate that. But in keeping with the conservative portfolio, I'm going to use a lower constraint. Let's just say I don't want any position to be greater than 6%, and I like to use a threshold constraint. Okay, so I'm going to set my rebalancing and reoptimization. You always want to have a rebalancing policy. It's really the closest thing to free lunch that's out there. So especially when combined with a diversification weighted strategy, rebalancing is just going to add almost maybe a percent, occasionally more, but good chance of around 1% of additional return in the portfolio, which is more than half the yield that you're getting in your conservative bonds right now anyway. All right, here I'm going to set our benchmarks and choose what I would like from a notifications perspective, and I'm going to go ahead and click to generate my backtest, and drop in the number that you want your text-based notifications to go to, and select how long you want to backtest that strategy for, and we'll order it up. Alright, so this knows me in the system, so it's asking for my password, and there we go. Alright, this is going to take just a minute to go ahead and build, and then we'll check out the results, and we'll see if it's something that me as a conservative investor thinks not only has it served me well historically, and also I'm doing some things in this portfolio that I think are more future oriented. So while the infrastructure, I think most of the days of infrastructure will be in front of us, so that won't really appear into the results. Maybe the genomics will a little bit, but I really want to evaluate the backtest from the risk perspective, even more so than the return perspective. So we'll get our numbers back. We report risk on a couple of different metrics, so we'll see how they stack up. I can make sure that those are in line with my conservative strategy. Okay, here we go. We got our results. All right, first thing I see is the 3D image. That image tells us how diversified we are by equating portfolio balance to physical balance. So big and round is good, and when it all juts off to one side and it's out of balance, then that's an additional risk of the portfolio. Even if it doesn't show up on your risk metrics, an undiversified portfolio is a more risky portfolio. But I'm liking what I'm seeing there from a diversification perspective. One way of double checking that is to put these boxes on, and we can kind of test for exposure across these different boxes. And I'm seeing we've got, pretty good exposure across these boxes. So what that means is for any kind of potential direction in the market, there's always going to be a combination of our assets in this strategy that are going to outperform holding cash. Okay, the P&L chart, I'm liking what I'm seeing there. The benchmark is set based on our asset allocation. So it is 50% fixed income, 50% or 25% stocks and 25% cash. And let's check out our capture metrics here. Up capture, down capture looks wonderful. Anytime you can see, ideally you keep your down capture under 100, but with the up capture so much greater than the down capture, we really like that. I'll always love, an alpha, and of course, here the returns are really delivering for us. Let's dig in a little bit. Obviously, from a returns perspective there, I like what I'm seeing. Let's dig in a little bit. So our biggest positions, nothing bigger than 6%. That's in keeping with a conservative strategy. And let's click into our risk numbers. Okay, here we go. Standard deviation of 18%, semi-variance of 12%, and a maximum drawdown of 24%. All alts is under 5. That's quite good. For comparing this to a 50-50 portfolio, I think we're hitting our marks for our risk measurements. Let's take a little bit more dive into some of the analytics here. Our fiduciary diversification, which is really your total diversification. So this is the diversification that we would hold any fiduciary accountable to. So it's a good tool to to plug in an existing portfolio, and if you have a current advisor or what's in your current strategy, see how it stacks up. A lot of people are less diversified than they think they are, so you can use this as an analytics engine and check it out. But here we're into the green, so that's pretty good. Our systematic diversification, this is the hard one because it typically the more market risk you take on, the harder it is to get good systematic diversification, and you need a lot of that market exposure to get your returns up. So I'd like to see this a bit higher, but in light of the performance I'm seeing, I might be able to forgive that. And our idiosyncratic diversification is all the way into super abundant, which just means you've got more than enough. That's never a bad thing with diversification, but if we needed to, we could live without maybe some of it. But never would need to deliberately dial back your diversification, presuming you had it checking out in all the rest of the metrics. Also, what I love seeing here, even though we've got such strong performance in this strategy, we don't have any assets that are really responsible for so much of that performance. So we've got, this is what I like about this portfolio strategy and what I was kind of hoping for. It's really designed to work together, and that's how our optimizer works, combining the predictions with some deliberate selection, and then the optimization process, and not just optimizing it once, but continually re-optimizing it. You can see that we've re-optimized this portfolio a number of times, and each time we re-optimize that portfolio, we're refreshing our predictions, and we're coming up with new weights and potentially new investments, because the investments that we want to be in at any one time change. And this whole process of re-optimizing, which we've pioneered, is very, very cognizant of that. It helps to improve diversification, and we think it gives you a chance to perform better too. Just passing the sanity test of what's inside this thing. Looks like some of the miners came back big in terms of how we would allocate now in the conservative strategy. Then we've got really a nice lineup of different fixed income assets. So this is really what you want. You want your diversification broadly sourced, coming from a lot of different kinds of opportunities. And now we're here, generally smaller allocations into the individual stock positions, so we're not taking on too much idiosyncratic risk with any specific stock name. There's a lot to like about this. We put in, what do we end up with here? Looks like a little over 100 names, and the system has us investing in about 30 of those 100 names at any one time. It looks like it's been reasonably consistent about that, although the 30 that we're in would vary from time to time. So my biggest red flag in this portfolio for a conservative investor, one, of that down capture, two, the maximum drawdown. And maximum drawdown is always one where you want to be matching up the value that you see to the look back that you had. And this was a 5-year analytics look back over the last 5 years. The big drawdown event was the spring break of the COVID crisis. So that'd be a good sort of litmus test. If you lost 24% of your portfolio value then, and you felt comfortable for that in a conservative strategy, then you're probably all right. If you need something more conservative, then you're probably going to have to go back and adjust those policy constraints to make things a bit more conservative still, which is, of course, easy to do in the system. But for a 50-50 portfolio, I feel good about where we are. And, inflation appears to be upon us. The money printing is catching up, and this is a good way to position your portfolio to address that. So please subscribe to the video, and I hope this helps. Thank you.